Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome in this video. This video is a continuation of my previous 5 videos on a topic ratio analysis. Viewers, in my previous 5 videos, so far I have covered 5 important categories of ratio analysis, namely liquidity, solvency, profitability, efficiency, and coverage ratio. In this video, I will cover the sixth category of ratio analysis, namely market prospect ratios. Viewers, when we talk about market prospect ratios, they help investors to predict how much they will earn from specific investments. The earnings can be in the form of higher stock value or future dividends. Investors can use current earnings and dividends to help determine the probable future stock price and the dividends they may expect to earn. The key market prospect ratios include dividend yield, earning per share, the price to earning ratio, and the dividend payout ratio. We will cover all these ratios in detail. So let's have a look at dividend yield ratio. Viewers, dividend yield is a financial ratio that measures the annual value of dividends received relative to the market value per share of a security. In other words, the dividend yield formula calculates the percentage of a company's market price of a share that is paid to shareholders in the form of dividends. As you can see the formula, dividend yield is equals to dividend per share divided by market value per share. Let's understand this with the help of one example. Suppose that the company A trades at a price of $45. Over the course of 1 year, the company paid consistent quarterly dividends of $0.3 per share. The dividend yield ratio for company A is calculated as follows. First of all, we will add all quarterly ratios, and the sum of all quarterly ratios we will divide by the given share price. In our case, it is $45, and this will give us a percentage 2.7. The meaning is that an investor would earn 2.7% on shares of company A in the form of dividends. The next ratio under this category is earning per share. Viewers, earning per share is a financial ratio which divides net earnings available to common shareholders by the average outstanding shares over a certain period of time. The EPS formula indicates a company's ability to produce net profits from common shareholders. This guide breaks down the earnings per share formula in detail. A single EPS value for one company is somewhat arbitrary. The number is more valuable when analyzed against other companies in the industry, and when compared to the company's share price, the price to earning ratio between two companies in the same industry with the same number of shares outstanding, higher EPS indicates better profitability. EPS is typically used in conjunction with the company's share price to determine whether it is relatively cheap or expensive. Cheap means low price to earning ratio, and expensive means high price to earning ratio. Let's have a look at EPS formula. We have several ways to calculate earning per share. So below are two versions of earning per share formula. Earning per share is equals to net income minus preferred dividends divided by end of period shares outstanding. And the next formula is that net income minus preferred dividends divided by weighted average shares outstanding. The first formula uses total outstanding shares to calculate earning per share, but in practice, analysts may use the weighted average shares outstanding when calculating the denominator. Since outstanding shares can change over time, analysts often use last period shares outstanding. There is also often talk of diluted EPS in financial reports. Diluted EPS includes options, convertible securities, and warrants outstanding that can affect total shares outstanding when exercised. Another type of earning per share formula is adjusted EPS. This removes all non-core profits and losses as well as those in minority interest. The focus of this calculation is to see only profit or loss generated from core operations on a normalized basis. Earning per share formula, let's have a look at the example. Let's assume that company ABC has a net income of $1 million in the third quarter. The company announces dividends of $250,000. Total shares outstanding is at 11 million. The earning per share of ABC Limited would be earning per share $1 million, which is the net income, and minus the dividend, which is $250,000 divided by total shares outstanding. And this will give us the earning per share $0.068. Since every share receives an equal slice of the pie of net income, they would each receive 0.068. The next ratio is price earning ratio. The price earning ratio, or in short PE ratio, is the relationship between the company's stock price and earnings per share. It is a popular ratio that gives investors a better sense of the value of the company. The PE ratio shows the expectations of the market and is the price you must pay per unit of current earnings or future earnings, as the case may be. Earnings are important when valuing a company's stock because investors want to know how profitable a company is and how profitable it will be in the future. Furthermore, if the company does not grow and the current level of earnings remains constant, the PE can be interpreted as the number of years it will take for the company to pay back the amount paid for each share. Price to earning ratio formula: PE ratio is equals to stock price per share divided by earning per share. Let's have a look at the example. If stock A is trading at $30 and stock B at $20, stock A is not necessarily more expensive. The PE ratio can help us determine from a valuation perspective which of the two is cheaper. If the sector's average PE is 15, stock A has a price to earning 15 and stock B has a price to earning 30. Stock A is cheaper despite having a higher absolute price than stock B because you pay less for every dollar of current earnings. However, stock B has a higher ratio than both its competitors and the sector. This might mean that investors will expect higher earnings growth in the future relative to the market. The PE ratio is just one of the many valuation measures and financial analysis tools that we use to guide us in our investment decision, and it should not be the only one. The next ratio is dividend payout ratio, or in short it is DPR. So let's have a look. The dividend payout ratio is the amount of dividends paid to shareholders in relation to the total amount of net income the company generates. In other words, the dividend payout ratio measures the percentage of net income that is distributed to shareholders in the form of dividends. Let's have a look at the formula. There are several formulas for calculating dividend payout ratio. The first one is total dividends divided by net income. The second one is 1 minus retention ratio. The retention ratio, which measures the percentage of net income that is kept by the company as retained earnings, is the opposite or inverse of the dividend payout ratio. The third one is dividends per share divided by earnings per share. So we have these three formulas to calculate dividend payout ratio. Let's have a look at the example. Assume that company A reported a net income of $20,000 for the year. In the same time period, company A declared and issued $5,000 of dividends to its shareholders. The dividend payout ratio calculation is as follows. Simply, we will divide declared and issued dividend of 5,000 by the net income, which is $20,000. So this way we will get dividend payout ratio 25%. A 25% dividend payout ratio shows that company A is paying out 25% of its net income to shareholders. The remaining 75% of net income that is kept by the company for growth is called retained earnings. Viewers, the ratios we have talked about, these ratios are important ratios under that category of market prospect ratios. This video is the last video, and in this video I have covered the last category of ratio analysis, namely market prospect ratios. I hope you would have liked this entire series of videos. I have divided all these categories into 6 videos so that whenever you want to know about any of the important categories, you can do so easily. Thanks for watching. Viewers, do subscribe to Finance Specialist channel by clicking on subscribe button and hit the bell icon to get the intimation of my upcoming videos on some other useful topics. You can share your thoughts in the comment section. Stay blessed. Thank you very much.